Wittman manages a 19,000-acre dryland crop, range cattle, and timber operation in northern Idaho in partnership with 3 other family partners. He also provides workshops and private consulting to farm, ranch, and agricultural support businesses. He is past president of the Farm Financial Standards Council, contributing editor to the Farm Futures magazine, has served on the faculty of the TPAP Ag Executive Program in Austin, Texas, and is an adjunct faculty member of Texas A&M University. He's also a founding member of FamilyBusiness.ag, a ag peer group of consulting professionals promoting excellence and integrity and empowering continuity in the agricultural family business consulting profession. Please join me in welcoming Dick Wittman.
Thank you, Norm. Am I coming through clear?
You're very fine.
And are you seeing the screen share with the PowerPoint?
Yes.
Okay. Well, let me just take off here and first of all, a big thanks to Norm for your many, many years of dedicated service and passion. For those of you who've known Norm, I've worked with Norm since the early 80s, watching his software from its infancy. And he's truly one of the leaders and survivors in a very tough industry. Particularly appreciate your willingness to innovate in this COVID environment. And while it's not as perfect as face-to-face, providing real service here today by having this Zoom process. My goal today is to condense basically a 2-day workshop on management accounting into 2 hours. So we're going to be hitting pretty high level points, but hopefully this can set a stage for some of the discussion later today and in your case study work. My expectation from this group is that while there are a lot of new facers in the group, the fact that many of you are using FBS or you're considering it, I consider you to be kind of the high end of farm managers in terms of your sophistication and willingness to apply a lot of the concepts we're talking about today. So with that, I'm going to start rolling down through this PowerPoint, and for anybody that would like, we'll furnish you a PDF of everything that you're going to see here today. So don't worry about taking notes. If you would just follow along with the discussion here. If anything, take notes of questions you'd like to raise at some point. You can send them to Norm via chat, and he will interrupt me occasionally, and we'll have time afterwards for Q&A. So with that, I'm going to roll here. We're going to talk first about kind of how the management accounting guidelines came to be with the Farm Financial Standards Council process. Why these are important, what's the linkage between management accounting and strategic decision making, connect the dots of what management accounting has to do with activity-based costing, and then we'll share with you many of the strategies that farmers have used to try to implement this better. Very quickly, the Farm Financial Standards Council has been in existence since early 1990s. And we are not a replacement for the AICPA, but we're the supplementary organization in agriculture that helps fine-tune guidelines for analysis and farm financial statement presentation. We had a huge industry demand in around 2000 for better cost accounting information, better standardization of data so that we could do benchmarking. And so the council took this on as a project in basically 1998 and formally launched in 2000 a task force. 40 people on the council deliberated almost 6 years to get the final guidelines out. And I've been probably one of the most frequent educators in the US on this topic ever since. It's complex, but it's teachable, and those who want to be leading edge really need to understand this. If you look at the number one concern that we've had clear back to 2008 and 2009 and then through 2010 through 14, and now we're rolling it to the present, it always seems to be the same issues. How do we deal with rising input costs, when are we ever going to have normal? And what we're learning is the new normal is volatility. And we're just in some continuous phase of abnormality or volatility. So this puts a lot of pressure on us to really understand costs and understand what our strategic options are to survive. I'm now retired as manager. I'm board chair and transition coach of our operation. But when I was actively managing, I had to remind myself, what is my job daily? And if you were to put your job as a manager in one sentence, how would you answer that question? This is the way I've answered that. The job is to empower a skilled team of responsibility center managers to make quality decisions. And I want you to focus on three key terms here. A skilled team. Of course, we want people with the right skills, but we also want people with the skills where they can effectively manage a unique part of the business, which we call a responsibility center manager. And we want those managers to make quality decisions. My job is not to make the decisions, it's to hire people who can make those quality decisions. So what are the questions that each of these managers are making constantly? What strategies are successful? Which ones should we change? How will a change impact financial performance? And what information do we need to make better decisions? If you summed up in this picture virtually every decision that a farm or ranch person makes in a year, it's all contained in these two circles. We make operating and we make strategic decisions. So in the inner circle, you can see that every year we make decisions concerning what to produce, how to market it, how to finance it, what our capital replacement process will be, and then we go from there. And it's an annual focus. But while we're doing that annually, we're also, whether it's written down or not, we have a strategic process that we're currently following. And it addresses what our crop rotation is, whether we're growing or not, what our tillage system is. And if you go around this circle, every one of these strategic approaches is or should be under the microscope. And the key question from strategic management is, do we keep on keeping on, or do we consider doing it differently? And if we're going to consider a change, how do we analyze the impact of that change, and will it make financial performance improve or not? As we look at the management information system hierarchy, we start with the most simple box at the top, which is everyone has to file a tax return. And to do that, we get cash basis net income. All of you probably would agree that that's virtually worthless for analytical purposes. The next level of detail moves into what we call external financial reporting, where we can convert to accrual-based income statements. We look at cost and market value balance sheets. We look at capital debt repayment analysis. And this is good whole farm analytical information that says, are we successful or not? It's great for investors and lenders, but it doesn't give us as managers any information on why are we successful. And that's why we need to move into the drill down deeper into the business and look at managerial reporting. This is the level of reporting that's useful to segment managers, the people that are in the trenches in production and marketing and equipment support. It's where we tie the financial and the physical together. We look at profit and cost centers. Our focus is on cost of production. And we're trying to compare actual financial performance with economic opportunity analysis to see if we should be considering doing something different. So what are the key questions that we ask for each profit center in the business? How does cost of production compare to our peers or your own historical trends? How are our trends impacted by changes in tillage, genetics, or production strategies? How is performance affected by growth, price and yield variability, or key input cost trends? And lastly, and this is one that I think we don't give nearly enough attention to, is how is capital asset use efficiency affecting return on equity? So one of the questions that we would ask is, how can management accounting be used to measure the impact of strategic decisions? There's 5 key steps to strategic management. First, we analyze cost and activity in each center. Secondly, we identify strategies that influence performance. Then we simulate these alternative decisions. Number 4, we implement what looks to be the best option. And then 5, we measure the impact. And this is a basic process that we go through in analyzing any strategic change in a business. And I won't do any detailed discussion about strategic management today, but farmers and ranchers and livestock people have been looking at a number of revenue enhancement strategies. You can read through this list and probably recognize some of the things here you try to do. We've looked at strategic options to address cost, and many of these items in this list, many in this group have pursued as cost management strategies, but there's no limit to the things that could be in this list. But anytime we want to take a look at one of these changes, we have to look at the fact that a change in strategy is going to impact the operating plan. It's going to impact our financial performance. One of the things that we need to figure out is what are the metrics that we're going to use to measure financial performance. And it's really easy to get bogged down in the sweet 16 or the legal 21 ratios. And we get so bogged down in all this detail, we lose sight of the forest for the trees. I'm going to take a very fast pass through what the key ratios are in financial metrics. And my goal here is to get us to really agree that there's 5 or 6 key metrics that we should clearly understand. And those are the ones that we want to make sure we're monitoring and we understand what they mean. If you look at the financial metrics that the council has developed over the last 20 some years, they fall into 5 categories. And I'm going to just quickly review these categories, but I want us to go away agreeing that there's approximately 5 key ratios that should always be right front and center on our dashboard. Liquidity is a critical issue that measures the ability to pay bills as they come due. I won't spend any time on this. I think that's well understood. Solvency, look at your debt structure in relation to your equity and looks at your ability to withstand risk. It's measured a number of different ways. Debt to asset ratio is probably the most popular measurement. Many of these slides, you'll see data that shows the median number for people that participated in TPAP. I quit publishing these, but this just shows you that these can move all over the board from year to year based on a group of people. Profitability is measured both in dollar amount, but also if one of the top 5 metrics we should be keeping constantly on our dashboard is operating profit margin ratio. This along with asset turnover is a key driver of financial performance, and we're going to show you in a minute how to connect that. Return on assets and return on equity are 2 more of our top 5 that should be front and center. Return on assets is looking at your ability to generate net income based on a base of assets. Return on equity is more of an investor metric that says after you've not only paid your operating expenses, but you've paid your debt providers, what is the return to the individuals putting equity into the business? So one of the critical foundations for all of these ratios is it presumes that you have a foundation of converting cash to accrual net income. If you don't have accrual-based net income, then virtually all of these ratios are garbage. Just a little interesting side bit. Every year when we run the TPAP program, we require participants to fill out a 5-year trend sheet. It's amazing how many people pull this data off their tax returns, and then when they get to TPAP, they realize they've had an interesting exercise, but the data is virtually unusable because it has not been based on accrual adjusted data. If we had more time today, I would make you actually take time to do this really simple cash to accrual net income case study. And it has basic data on sales, expenses, changes in inventory, changes in payables, investment in growing crop, and what is book versus tax depreciation. This is pretty much a first grade level quiz that anybody in the financial arena should be able to do in a matter of minutes. But I'm it's scary to tell you that in audience after audience, pretty progressive farm managers who are very sophisticated in a lot of areas, 3 to 5% of a group, 100 people, will get this correct. Years ago, when I presented at the Agricultural AICPA convention, 300 accountants in a room, less than 7% could get the correct answer to this. And I could go into lengthy detail of why that is, but a lot of it is that we first of all don't truly understand it, and second of all, a lot of our modern bankers, our accountants, are so used to having software where you fill in boxes and basically it cranks out a number. We don't even know why it gets the number it gets in. So I don't want to belabor this, but I can't stress enough that everything that we do going forward and looking at financial performance is absolutely hinged on having accurate accrual-based net income information. So the answer to this quiz basically is, on a cash basis, you have a cash basis net income of $25,000. On an accrual basis, the accrual income is $300,000, which is, if you were relying on cash basis data for your information, you're only 8% of the correct answer. And I put this final slide in here because most of you are quite familiar with the impact of changes in inventories and payables and how to address prepaid expenses. But an often overlooked adjustment is the difference between tax and book depreciation. And in this world of rapidly writing off assets, that failure to address what book or economic depreciation is versus tax could contribute to $150,000 error in your accrual net income. So the Farm Financial Standards Council, many years ago, took the position that we could use tax depreciation for a proxy for cost. And in our modern guidelines, we strongly recommend that we use books, not tax depreciation, because it's a more accurate representation of true machinery depreciation cost. This slide is an illustration of, if you failed to make the depreciation adjustment from book to tax, how far off the net income calculation would be. In the bottom line of this slide, you can see that the depreciation adjustment as a percentage of net income ranged anywhere from being right on in 2011 to being 33% off in 2009, 86% in error in 2013. And if you remember, in 2013, that was a high crop price year where there was a huge percentage of operations that bought iron and wrote it off in 1 year. So the importance of doing an economic or book depreciation versus tax to get to a true accrual would have been super important in that year. Another key metric is asset turnover ratio. So this is one of our top 5. And this talks about how efficiently you can generate farm assets with a base of revenue. And I can't stress the importance of this ratio along with operating profit margin. They're key drivers of financial performance. So I'm going to tie these ratios together really quickly with a quick discussion about the DuPont model, which is a financial model that shows the interactivity of many of these financial ratios. And the key drivers that we're trying to connect are asset turnover ratio, operating profit margin, and then also the relationship of financial leverage. So using the old concept of new math, if I wanted to evaluate bottom line performance, I could look at return on asset. But if I want to look at what drives that, I can look at 2 causal ratios. Turnover ratio times profit margin will actually also give you the same answer as return on assets. And to prove this, we just cancel out the gross revenues, and you can see that net farm income divided by average farm assets is ROA. But now, instead of a bottom line answer like ROA, we're looking at 2 cause-effect type ratios where strategic change options can be looked at. What can we do to change turnover ratio? What can we do to change profit margin ratio and get more efficient? Going to ROA, you can't say, what can we do to change ROA? It's not a cause effect, it's a bottom line indicator. Taking this a step further, return on equity is a product of 3 cause effect ratios: profit margin, turnover, and your assets to equity ratio or leverage. So again, we cancel out common terms to prove that this works. And now we can look at strategies in 3 different categories that impact net farm income over equity. And we can look at our profitability, our turnover effectiveness, and our leverage strategies. So if we take these 3 concepts and combine them, this is a chart that was developed by Centrec Consulting, Todd Doring, years ago. And any of you that's ever milked a cow and sat on a 3-legged stool realize that's a very stable way to stay upright. And if you take the DuPont model, if you look at our bottom line goal, it's really to maximize return on farm equity. We want to build equity, and we want to have an estate we can pass on and have financial security at the end of the line. But the 3 main drivers of that, profit margin, asset turnover, and effective use of debt leverage, all drive home to affecting this return on equity. So this model allows us to look at strategies that we might employ to improve profit margin and how that affects ROA and how it eventually affects return on equity. We can look at turnover ratio, and we can see how it affects return on assets and how it affects return on equity. We can also look at the impact of higher or lower debt equity, and as also the cost of the equity or average debt financing to see how that impacts bottom line performance. So in a longer version of this session, we would actually do a case study on a farm transitioning from conventional to no-till farming. And we actually did a test group of 40 producers many years ago where they kept track of their financial performance in a pre-conversion to a post-conversion to a new farming system. And this is not an infomercial for no-till. It simply illustrates that we can measure the impact of strategic change. This group of producers doubled their turnover ratio. So on average, everybody in the group had doubled the size of their business. Profit margin ratio had increased 1/3. Return on assets had gone up 2.5 times. And return on equity, which is the one we're really interested in, went from 4% to 23%. This was a huge epiphany to people that looked at, can we measure strategic change? Can we look at the impact of all the things that are going on in our business and look at it before and after and see if changes in strategy can increase ROA? So this is a really quick and dirty comparative analysis of what are the best options for improving bottom line performance. So let's take this base case, and if many of you were watching this, you'd probably add a 0 to all these numbers because this is a fairly small financial presentation here. But if our base case scenario, what we experienced a year ago, was a 5.5% return on equity, case B, let's look at the impact of growing the business 10%. So we're going for operating efficiency, spreading overhead costs, and so forth. So the only things that are going to change in that case are variable revenue and variable costs. That change resulted in an increase from 5.5% to 9% return on equity. So I asked the question of audiences, what do you think will help more? Increasing revenue and growing, or increasing cost efficiency, staying the same size but becoming more efficient? And it is about 50-50 on the answers of growth is better or cost efficiency is better. So in this case, we're going to cut costs by 10%. And you can see that the return on equity actually increased significantly more than growing the business. So can we use that as a generalization that cost efficiency is more effective than growth? I used to say that until I got corrected one day, and somebody, a widely known and respected academic on the same program with me, said, growth will do more for your business than cost efficiency. And that completely conflicted with my numbers here. So we got together and started studying this and realized that it's, as an economist, you would expect this answer. It depends. It depends on how much of your cost structure is fixed versus variable. So you can see in this case study, a huge percentage of the cost structure is variable costs. So in that case, cost efficiency is going to pay more to the bottom line than growth. But if we were in a high fixed cost industry like a cow-calf operation, and we had a high fixed operating cost, in that case, growth would do more for your business than cost efficiency. So the lesson from this is that it's not enough just to look at the bottom line costs. We need to look at what the mix of our costs are between variable and fixed costs to see which kind of strategies will do the most good for our business. One of the tools that we use to make a change in operating efficiency is called the partial budget. And before you can determine, well, should I do something different than what I'm doing now, we need to be able to financially simulate what are all the changes that would occur in our financial structure if we're going to make a change. So you can use this form to say, all right, if I'm going to make this strategic change, what changes in assets occur? What change in liabilities? What change in fixed expenses occur? What change in variable expenses? How will change in revenue occur overall? And we can take a look at these partial budget situations and look at payback period and bottom line impact. And then we can put that data into their DuPont model to see how this would impact ROE or ROA. This is a really valuable exercise that I think many of us should be doing annually after we get our year-end financials. So what are the key benefits from management accounting? One of the first benefits, and I think the most important, is that we get to a truly accurate unit cost of production. It also allows us to analyze activity by center and provides a basis for evaluating the managers who actually oversee those centers. It helps us identify management behavior and where we can improve. And lastly, it gives us a more meaningful way to evaluate work in process and inventory valuation. This schematic shows what the total flow of financial statements is in any financial transactional system. And it simply says that we start out the year, number one, with a balance sheet and the income statement that shows revenue, expenses, less withdrawals, explains how we get from a beginning to an ending net worth. And the statement of change in financial position illustrates how the beginning and ending balance sheets change. We roll this forward into the coming year, we can use a cash flow budget, we can do accrual adjustments to get to a pro forma income statement, and we could actually build a pro forma balance sheet at the end of the cycle. Now, the two things that I want to call your attention to in this slide are in the 1231X2 balance sheet, you see assets circled where one of those assets is work in process. In most farm accounting systems on a cash basis, when we write a check for seed or fertilizer or chemical, we're expensing it out, and then at the end of the year, we're putting it back on the balance sheet as an investment in growing crop. But throughout the operating cycle, every time we write those checks and we treat them as an expense, net income goes down, net worth goes down. So throughout the year, we have an extremely inaccurate balance sheet. And then at the end of the year, we record the value of all these prepaid expenses. We put them on the balance sheet as a current asset, and voila, our net worth increases. One of the fundamental aspects of management accounting process is that, and rather than treating these investments in production as expenses, we treat them as a work in process asset. And it's not easy, but it it's probably the number one thing that contributes to increased accuracy in the financial structure. So I want you to follow this connection. One of the next steps for many of you in this room will be, will I continue to treat cash expenses as cash deductible throughout the year and then simply make an adjustment at year end? Or do I want a real-time way of tracking investments in production, and then at the end of the production cycle, I can roll them into cost of goods produced? I'm going to admit another participant here. Okay. So how do we get into management accounting? This is where we're going to get into the nuts and bolts. We start by learning the core concepts. We standardize definitions, work through a case study, and then test drive in your own business. There's 6 key concepts. First is that we have to use accrual accounting. The second is that we build the system around responsibility centers for accumulating transactions. The third is that we integrate production with financial measurements. So instead of just dollar amount reporting, we're now comparing dollars in relation to bushels, hundredweight, or per cow, or per acre, and so forth. The fourth concept is that core transaction information is accumulated, and then we supplement that with economic analysis. We don't do economic analysis within our transactional system. We need to follow GAAP. We need to be able to handle multiple commodities. And lastly, we need to be able to handle multiple period production cycles. And what that means is you might have a livestock operation that starts in the fall of one year and finishes the next year. You could have a perennial crop operation like bluegrass that takes 2 years to establish the crop, has a 7-year life. And how do you get to a cost of production when you're dealing with a cycle that goes over multiple years? Feedlot may only have a few months cycle. A hog operation, again, may not even be a full year. So how do you deal with some of your crops that have an annual, some of your crops have a part of your cycle, and some of your crops have a multi-year cycle? Early on in the council's challenge, we spent a lot of time trying to standardize definitions and terminology, and I would challenge any of you in this group to download the guidelines from the council and become familiar with all that, both the financial guidelines and the management accounting guidelines, because there's extensive detail that addresses all of these issues. Unit cost for production is one of the most important issues we're trying to get at. And it addresses what the total costs are that have to be covered, what's the minimum price on the marketplace to make a profit. And typically when we design reports out of a management accounting system, we want to have 3 dimensions. What are the total cost of unit produced? What's the dollar per base unit of production? For example, total dollars per acre, or total dollars per cow, or per hog. And then we want the total dollars per unit of marketable production. Because this is the number that you go to the marketplace and say, I have to beat this number to make a profit. So marketable production may be different than what you totally produce, particularly if you're in a crop share situation. And so it's important to know what you totally produced, but to also segregate out what portion of that production is yours to sell and what are the dollars that have to be covered by that marketable production. When we get into definitions, one of the ones that really confuses people is the difference between direct costs and indirect costs. And this is fundamental to management accounting, because an indirect cost is a cost that's common to 2 or more cost objects. So for example, if we write a check for fuel and it's going into tractors and combines and they're farming multiple crops, we can put that in a pot, but then eventually it's going to have to be allocated to those multiple crops. We write a check for fertilizer for the corn crop for the 2020 year. That's a direct cost, and we can assign that directly to the production cost center for corn. So direct costs are fairly simple. It's the indirect costs that create the biggest challenge in the management accounting system. The other big definitional issue that's important to get resolved is what is a cost versus what is an expense. A cost is associated with building an asset value that's inventoriable or capitalizable. So think of this as work in process or WIP. An expense does not build value. So like period expenses such as interest, marketing costs, transportation, professional fees, these are items where when you write the checks, they're an expense that has to be paid, but they don't build any value in your inventory. The next challenge for the manager is, how do we decide what centers to track? This is where we start by saying, what are the primary products that we're in business to produce for a profit? And what kind of management behavior are we expecting out of our center managers? And is there enough activity to make it worthwhile to track performance? So each of you need to look at level of activity, what your goals are for profit, and then you look at how do we set up what's a profit center and what's a cost center. So here's a couple examples. If we're producing hay or corn as a production activity, if we're in the business to produce a huge amount of corn for profit, we would have a production cost center and a profit center. But if we were in the hog business and we only grew corn to support our hogs, or we're in a dairy business and we're only growing hay or corn to support our dairy, and we're not in the business to grow these crops, we would not create a profit center for hay or corn. We would create a corn cost production center, so we know what it costs to grow it, but we're not growing it for profit, so we would not create a profit center. Custom trucking or fertilizing, same issue. Many farmers do a little of this on the side, and it's not their primary business for profit. So in this case, the revenue that comes in from these items becomes a cost reducer or cost recovery to the equipment cost center, as opposed to a separate profit center for custom trucking. So these are new terms that we need to get more familiar with, where we take a hard look at, is what we're doing here revenue? Is it cost? Is it revenue recovery or cost recovery? There's four basic kinds of centers in a cost accounting system. There's production centers, support operations centers, SG&A, and administrative and financing. So let's take a sample flow chart. In any business, you're going to have the same process of allocations where we start with our support cost centers. These could be machinery, they could be labor, it could be general farm overhead. Each of these support cost centers needs to be allocated to the production cost centers. Let's say we're growing corn and soybeans here. For every profit production cost center, we would have a production profit center, And at the end of the cycle, the thing that's different in the management accounting system is that we capture all of the bundle of costs in our cost centers, and we flow only to the profit center the portion of those costs for the items sold. The portion of costs that are not sold would remain in inventory on the balance sheet at cost. So at the end of the year, we would have an income statement that would only show revenue sold less cost of goods sold, and any remaining inventory would remain on the books at cost. That doesn't mean we can't build a market value balance sheet showing current market value, but we would always be getting an accurate, up-to-date, dynamic, real-time balance sheet showing net income on items sold as well as inventory that's been unsold. So let's illustrate this with a really quick farm and custom farming operation. So in this particular case study, there's 3 crops. There's also some custom application. There's clear division of responsibility in the management team, where there's a crop production, there's a marketing, there's a equipment support manager, and a general manager. So the tax and the solution, or excuse me, the challenge in this case is to define the profit centers, what accounts would normally be tracked in each of these cost and profit centers, and then how do we allocate the transactions to the various centers. So in this particular case, we would set up 4 profit centers, one for the 3 crops we're growing. We are in the business to do custom application for profit, so we would have its own profit center. While there is some custom trucking, it's incidental, and so it's cost recovery. It's not a for-profit enterprise. On the cost expense center side, we would have a production cost center for each crop that we're producing, and these would be accumulating work in progress costs or transactions. We would have support cost centers for equipment, labor, general farm, and land costs. And then we would have finance and SG&A expense centers to track those transactions. So this is what a flow chart would look like, where you first start with tracking general farm overhead, labor, and land and equipment support. And then those items would be allocated either to the production cost centers, or in this particular case, a portion of those would go to the custom application profit center. At the end of the cycle, anything that's sold would show up in the wheat, barley, or canola profit center. Anything that's not sold, a portion of those costs would remain in the inventory value. So let's take a look at these boxes. All these boxes represent is a financial report. So this would be an example of a production cost center report, where you'd see your seed costs, fertilizer, chemical, crop insurance as direct costs, and all of your indirect costs would be allocated from a support center like general farm overhead, equipment support, labor support, or land costs. You also see in this report that if there was cost recovery, like incidental revenue from byproducts or straw, those would come in here as a reduction in costs to the production cost center. One of the questions many farmers are facing right now is, how is inflation and machinery costs impacting my cost of production? The equipment support cost center is a key place to get the answer to this question. If you track your own equipment support costs over a series of years, you could see that you have fuel, repairs, depreciation, equipment hire, equipment rental. You might have some incidental cost recovery from custom trucking, gains or losses on equipment sales, and then you bring your indirect costs in. And this is a great report for comparing your own costs over a series of years. It's also a good peer group report to look at what your bottom lines are compared to other farmers. The thing that you don't want to do with this report is try to compare your fuel costs, repairs, depreciation with somebody else's, because these are not comparable items. The problem with benchmarking line items is that if you don't have exactly the same strategic approach to your business as somebody else, you can draw completely erroneous conclusions from line item detail. And I'll give you a quick example. If farmer A was infatuated with new paint, had the most efficient, newest equipment, they'll have high depreciation, low fuel costs, low repair costs, no equipment rental, no custom hire. Farmer B might be infatuated with old equipment. They like to work on it. So they have high repairs, they have higher labor, takes more people to operate the equipment. They have virtually no depreciation because it's all depreciated out. And yet, bottom line, they may be comparable in cost. Farmer C may hate equipment entirely, and his only 2 pieces of equipment are a cell phone and a pickup. And they call in custom work for all of their work that's done. As you can see, each one of these will have a report that gets to their total equipment costs, but in a totally different and detailed way. So line item comparisons of their details would be virtually meaningless. This is an example of a farmer up in the Northwest who keeps meticulous records on a cost accounting basis. And he was fighting a losing battle on cost structure, where he finally completely retooled his operation, went to 100% to no-till, and started doing sharing combines and doing a lot of custom work. But you can see in this thing, his operating margin in 2013 was negative, and he was looking at a rising break-even price from $4 up to $7 on wheat. He completely re-engineered his operation, and even in a lower price structure, he went to a 25% profit margin. And one of the biggest changes there, he both impacted his variable cost due to operating efficiency and no-till, but he also spread his equipment over more acres, resulting in almost a 30% drop in his fixed costs. So how many of us would just love to be able to see what our data has done in our operations in a table like this? This to me is critical managerial information, and it's the feedback we want to see if we're making the right strategic changes in our operation. So this is an example of a production center, profit center report for one of the key commodities. And this same structure would appear for all three of the commodities in this case. We have revenue, we have production costs, we have a margin, we have our share of SG&A and finance, and we get to a bottom line profit margin for each of these profit centers. One of the first steps the council went through in the whole management accounting guideline project is we redesigned the profit center report. And so you see in this report, in commodity revenue, there's only one line. And it's what is the key commodity that you are in a business to raise for profit? And everything else in your transactional system is either going to be cost or it's going to be cost recovery. So let's use the illustration of a cow-calf operation. In your cow-calf operation, typically in an income statement, you would see calf sales and cull cow sales, and you might have some byproduct from selling some part of the animals. But what are you really in business to produce for profit? It's a wean calf. So the only thing you would show in this profit center report would be, in commodity revenue, would be wean calf sales, and cull cow sales would all be reflected elsewhere in this report as cost recovery. If you're in a crop business and you're producing straw, you would have wheat as your commodity revenue, and straw would be a cost recovery that would come in somewhere else to get to a net cost. This next discussion, I really want to challenge the listeners today, because many of you are either FBS users or you're thinking about FBS, and many of you are also looking at Cropzilla and Conservis and Granular and AgWorld, and you have John Deere software. So I want to challenge you to think about, when you make transactions in a bookkeeping system, what are the bare minimums you have to pay taxes, versus what are some of the components in the transaction that you have to be able to enter to fully create data for management accounting system. So on the left, the minimum thing you'd have to have, and you can do this in Quicken or QuickBooks, is a memo description, a date, a transaction number, who the vendor or customer is, what general ledger account assignment that would be, whether it's an asset, liability, income, expense, or equity, and the dollar amount. And so with those 5 or 6 data elements, we could describe enough transactional detail to do a tax return. So on a higher end program, these elements that you see on the right are the additional elements that are absolutely essential to having management accounting information. We need to know the units as well as the dollar amount. We need to know how that transaction is connected to either a profit center or a cost center. What's the production year that's involved? And ideally, we wouldn't track what production center. This could be what field or what pasture or production unit or lot of hogs or lot of cattle it relates to. So combining these two sets of columns, whether you're using FBS or Red Wing or FarmWorks or whatever, if you can't describe all this detail, you can't get to good management accounting data. And in my 20 years of teaching at TPAP, we poll the incoming classes every year. And about 46 to 50% of the users are using QuickBooks. And a high percentage of people, by the time we're done with the class, walk away feeling, I cannot do what I need. So keep this discussion in the back of your mind as we continue through this next discussion, because each one of you are going to be in a different place depending on what software you're using. And I think one of the big questions, hopefully for our debate after this workshop, is really talking about how do we decide what's the optimal way to configure our software through the accounting side, through the field record side, and how do these data elements get captured? So one of the challenges in management accounting is that we think differently than the old system where it was just getting to an accurate bottom line net taxable income. We have to ask ourselves, is this a transaction that involves revenue? Is it cost? Is it revenue adjustment or cost adjustment? Because it could be any one of those four things. In our longer versions of this class, we actually go through we call it shoebox case study, where we show all the revenue that typically shows up in your income statement and all the expenses. And when we compute the expenses on a per bushel basis, we come up with a fictitiously high cost of production per bushel. But when we rearrange that data to show revenue adjustments as cost recovery and get a more accurate management accounting looking report, we drop cost of production by almost 25%. So things like farm program payments, refunds on fuel, a lot of this stuff that we show up in revenue, premiums on stuff that has nothing to do with the crop that we generate, we overstate our cost of production. And the consequence of that is we set an artificially high target for what we need to sell at a profit. So there's a huge incentive to get to an accurate net cost of production. And in my 20 years of teaching this topic, I can tell you that most of the sophisticated farmers that have participated have come into the class with an overstated level of cost of production. And I think that's a significant challenge, is if we're doing that, particularly in tight margin situations, we're creating an artificial target that's too high to market against. So earlier I showed you two columns of data that gave us on the left minimum for taxes. In the middle column was the additional data to do good management accounting. Now I'm going to complicate the water a little further. Many of you are also saying, well, I want to track agronomic and livestock data, field record data. So all this information on the right is also information that we would like to track. And FSA compliance, crop insurance, inventory management, CCT loan information. What are all the crop inputs by field? What are the machinery activities by field? So as I look at these three columns, the holy grail in agriculture would be some wonderful panacea where all this stuff could interact and interconnect. And this is at the heart of what's been going on with all the software companies like FBS and Red Wing, where they've been, and many others in FarmWorks, who are trying to look at financial information on the left and the middle and physical data on the right and say, how do we maximize the management of this information? Do we take good accounting systems to track the basic stuff on the left, and would you use Conservice or Crop World or Ag World or Granular to track the stuff on the right? And then how do we integrate these columns together? How do we take something like CropZilla to do the analyticals for field financial information on equipment? And how do we take that data then and drive activity-based costing? There's just a host of questions that are driven by this screen. So later on in our discussion, we may want to come back to this screen because I think it's at the heart of the debate right now of how much weight do I put on my accounting system to cover all this? How much weight do I put on my ERP system? And really it's behind, it's the core of the theme behind the title that Norm gave for our talk today. You know, how do we really move ahead into management accounting? And it's the heart of it is in these three columns. So another topic in management accounting is what is transfer pricing? This gets to be very hairy when you have resources that you're creating in an entity that you're growing, or you could sell them or you could feed them to a livestock enterprise. We could use grain that used to be not much anymore. We would raise a crop and use part of it for the next year's seed. What if we have a rental house on the farm and providing it to farm labor? Is that labor cost or is it rental income? How do we deal with that? What about commodities like beef or milk or pork that's given to employees? So one of the primary principles in transfer pricing is that the accounting industry says we should transfer these items at cost. That is the academically correct answer, but there are times where that's simply not feasible. So for example, if we're going to butcher 6 beef cattle for employees at the end of the year, we might find it more expedient to simply take the market value of that beef and record it as revenue and do an offsetting entry to labor costs for room and board so that we get an accurate picture of our true labor costs and we get a more accurate picture of what we raised. But we never raised those beef to sell them. But the only way that we can get accurate labor costs is to compute some value for those beef that are consumed. The council's guidelines they're not hard and fast. What basically we suggest is that you pick a system and you follow that consistently from year to year, so you have consistency in your year-to-year comparisons and you have a valid basis of doing benchmarking. Don't change your accounting policies from year to year. So what I'm going to do now is kind of shift into a mode of what have farmers learned as they try to implement many of the concepts we've talked about today. The first thing we learned is that it is complex, but it is teachable. It has revived the desire to do financial ratio analysis. In the past, I think a lot of farmers saw ratios as simply an end in themselves. It's like, gee golly whiz, I did this. Now what do I do with it? But once we realize that these are critical metrics, or if we're going to look at strategic change, we have to have a baseline of what we did last year. And by knowing what these indicators are and looking at management accounting performance, we can simulate strategic change and use these metrics as an indicator of what changes will be the most valuable to our business. Another change is most farmers will try to do this. They won't get all the way, but they will get a huge amount of benefit by working with others on trying to go on the journey of implementation. There is no such thing as perfection, and every step that you take will actually make it better. The last point here is that fear is oftentimes the best motivator, and I'll tell you from our 40-member peer group that went through this test study in the early 80s, many of those who couldn't complete the data were looking over the shoulders of those that did. And their conclusion was, if I don't figure this out, I won't be surviving. I don't want to be competing with farmers who actually understand this information. So I'm going to go through several conclusions that break these results into more specifics. One of the first conclusions is that very few people on farms have the skill sets to do this well. They realize that in order to do this, we're probably going to have a skilled CFO, and that could be internally or outsourced. And in many cases, it's going to require significant change in the accounting software design and implementation. This is an example of the duties and responsibilities of the CFO. If you want to look at a highly comprehensive, more like a shopping list I have a sample job description for a CFO on the website. And this was done in an advanced management workshop for CFOs, where we collectively, as a group, laid out what the ideal scenario for a CFO could be. I would challenge you to look at this, download it, and say, what are all the things that someone could do with their CFO, and how many of these things do I need to have in my operation? And do I have the skill set internally to do this, or should I look at hiring somebody outside the business to provide these services? The second conclusion is that our management accounting system design needs to mirror how we manage our business and structure it. And it's crazy how few businesses have a documented organization chart, clearly defined roles and responsibilities, and clearly written job descriptions. I would speculate in this group that it's much higher as a percentage than the typical farm audience. But management accounting gives us a teachable moment where we have to look at three things. Who are the people that are managing the business? Who are your center managers? How do they appear on an organization chart? And what are their specific duties and responsibilities? And how does your management accounting flow chart fit with that? So if you think about this, the people need to match up with the chart, and your accounting system needs to be designed so that those people get feedback on the decisions that they make. If those three pictures don't connect, then there's something wrong with the design of your management accounting system. So one of the next steps for the council, once it got the guidelines, was how do we give commodities specific direction on how you could implement this in each commodity area. So we started out trying to do case studies for a crop and a livestock operation, and we realized that it was super complicated to do a case study for enough people to make it meaningful. So what we've gone to is trying to give people the concepts and help people to realize that no matter who you are, you can design a management accounting flow chart for your business. So here's an illustration of two different dairies. This is full service fill, where they do everything in-sourced. They'll grow all their own feed. They build their own replacement heifers. Their primary profit center is milk, but they produce enough corn and wheat to have a wheat profit center. And at the end of the year, they would typically have an inventory, heifers, corn and silage inventory, and wheat. So you can see the format of this chart. It starts like we've seen earlier, where we have our support centers for general farm, equipment, labor, SG&A, and finance. We have our production cost centers for milk and corn and silage and wheat. And we have our profit centers off to the right. So this next chart is Cell Phone Charlie. And you can see this is much more simplified, but the same general structure. Support centers on the left, our production cost centers in the middle, flowing to the profit centers and inventory on the right. Now, this may look more simple, but this is a 30,000 cow dairy, and full service fill is a 100 cow dairy. It looks more complex, but the amount of transactional detail that full service fill has to deal with is probably significantly less than Cell Phone Charlie. Cell Phone Charlie has a manure management center with a $24 million methane digester and a whole staff of people that do nothing but work on manure. They have a whole herd health division. So you can imagine the transactional complexity of this business. If you took each of these boxes and built them out to what the detail would be, it would be huge. But the bottom line is we're able to collapse that data where those who are managing herd health are getting data on the area they manage. Those who are managing feed get the data they need. Those who are managing equipment support get the data that they need. So what is the significance of these boxes? They point out the areas where management is focused by a center manager, and they provide the foundation for making strategic shifts for the business. So here's a quick and dirty case study, and in our 2-day workshops, we'll actually have the participants go around the room and work in groups to design a management accounting flow chart for their business. Here are 3 examples of some flow charts that were developed by participants in a workshop in Montana many years ago. This was a Wisconsin dairy workshop where you can see several different people develop flow charts. They're all different in detail, but they all followed a very similar format where they had support centers flowing into production cost centers and then into profit centers and inventory. Many years ago, I did a workshop for the Parker Ranch in Hawaii, where they also have a strategic initiative with the Ulupono group that takes the Parker Ranch's half of their calves go to Ulupono where they're grass fat fed, and then they're fattened and killed on the islands for the natives there. And what was interesting is we had 25 people in this workshop, and they had 5 different groups trying to design these flow charts, and they were all different. And they realized, these 2 groups here realized that the Parker Ranch's output was the Ulupono's input, and that they actually had to connect these 2 charts. But you can see that the same cost center, support center, cost center, profit center design could be applied to all these operations. In 2014, we did a series of workshops in Dallas and Chicago. And when we did the workshops in Chicago, we had 9 different sets of answers on flow charts. And while they were all different operations, you can see that the flow of transactional detail is very similar. And I'll never forget, one of the ahas that came, one of the presenters after they presented their answers to the flow chart said, "I just realized something. We should have done this before we designed our accounting system." And I wanted to say, "You think?" But I didn't. But the crux of this is, many times we design an accounting system with the thought in mind of getting a tax return prepared, instead of saying, what are the kinds of decisions that people need to make? And what information would they best need to support analysis of their performance? And it starts with this design. So I would challenge everybody in this audience today, if you were to draw out your own management accounting flow chart, what would it look like? And how would you take the principles that we're talking about today and draw this flow chart out? And then after you've done that, how does that impact how you tweak or redesign your current accounting system? The third issue is benchmarking. And benchmarking was one of the primary reasons why we were being pushed to develop management accounting guidelines. And we found out that this was a much bigger and much loftier goal than was realistic. I'm probably the world's biggest critique of bad benchmarking. I believe in it and I think it's important, but I've seen more examples of bad benchmarking than I have good. And a lot of it has to do with the fact that there are too many variations in business structure, enterprise mix, and methods of operation. I'm a strong advocate that each of you should do a 5-year trend sheet. And if you don't have a good tool for this, you can go to my website and download one and put your own data in there and see what your trends are doing from year to year, but then also develop a narrative, interpretive discussion for each one of those years about why the performance in that particular year did what it did. There are a number of credible sources out there for benchmarking in grain and dairy and hogs and cattle and machinery dealers. So this list is by no means comprehensive. Depending on the industry you're in, I challenge you to look for those leaders in your industry that are providing good data. I know John McNutt and Bob Lormeyer on the meeting today. They do some of the greatest work in the hog industry that I'm aware of. Farm Credit does some fantastic work in specialty crops and cattle. And on the East Coast, Cornell and Farm Credit are some of the best in terms of dairy data. So Again, this is not all inclusive, but there is some really good work being done within little satellite areas on benchmarking. I talked about the problems with having comparability. When we developed the standards, one of my duties was to develop what were the pitfalls in benchmarking. And if you look at this list, there are 10 potential ways where benchmarking data could be sabotaged. If you have diversity in farm size, commodity mix, you have different farm organizations or entities where maybe there's not arm's length basis in how they handle things. And so you're comparing your data against an entity where it's not the full picture of that business. You have businesses highly concentrated with owned versus those with highly concentrated leased land, where the financial metrics will be completely different. You have different practices on how we recognize income and whether or not we calculate deferred tax. Norm shared with you in the survey that this group has a relatively low adaptation or utilization of calculating deferred tax. And that's very consistent with what I see in the ag industry. You actually perform at a higher level than most of the surveys that I take on this topic. Valuation methods are all over the board. Some people want their financials to be super conservative. Others want them right up to true fair market value every year. And so if you're comparing financial metrics to a database where there's no consistency, this is extremely dangerous. A lot of differences in how people handle investments, operator draws, and labor contributions, again, where we can have lack of comparability. So I don't think we need to go through all these, but just be warned that the most valid benchmarking person to benchmark against is yourself. It's interesting to be in a peer group and share bottom lines, and I think that's useful, but the sharing line item detail is more dangerous than it's valuable. So each of you, I think the challenge for you is say, what are the metrics that are appropriate for your industry, and how do we look at this on a multi-year basis? Here's an example of a livestock operation in Montana, in Wyoming, where they have defined those metrics that are most critical to their managers and owners, and they share with their board every year the detailed data on ROE, ROA, debt equity, weaning, pregrets, crop costs. They know what every animal costs to bring to a marketable stage of production. And along with these trends, they furnish a narrative discussion of what each of these metrics mean. Super valuable information for managers and for farm directors or owners. The fourth conclusion is cost management is really a land of opportunity. As I said earlier today, I used to advocate that cost management could do more for you than growth, but that's not necessarily true. It has very much to do with what the breakdown of your cost structure is, whether it's heavily weighted towards fixed costs or heavily weighted to variable costs. One of the big costs that we do not do a good job of getting a handle on is labor and compensation, because so much of our labor cost is buried in the financial structure of the business, in housing, utilities, things that we don't account for as true labor. This compensation summary is a tool that I've used probably for 30 years. Anybody that has not seen this, you can go download a copy of it off the website. But it's a way of taking your senior people, your full-time people, and putting in there all of the actual cash costs like salary and wages, and all the non-cash costs like housing, utilities, meals, medical insurance, to get to a true cost. So if you have somebody that thinks they're making $24,000 a year, and when you add all the fringe benefits, they're making $60,000, and in order to compete with this package, they would have to be making $80,000 in town. We have somebody not looking at the true picture here if they're looking at 24 versus 60 or 80. And also from the farm manager's perspective, you've got a 1,000-acre farm, there's a $60 per acre labor charge right there. And you're competing with that 5,000-acre farm down the road where their incremental labor costs might be $10 to $15 an acre. So this is a critical cost element that we need to get a better handle on when we're looking at particularly benchmarking issues. This chart illustrates what can happen when we have significant differences in size of operation on overhead costs. So this was a actual set of data that came out of our no-till direct seed group, where the farms in that group ranged from 1,000 to 2,000 to 4,000 acre farms. And you can see the 1,000-acre farm, they're just completely out in left field on competitiveness. Their total equipment support and general farm overhead costs are 2.5 to 3 times what their larger competitors are. This particular farm came to the conclusion they wouldn't survive by doing what they had been. They realized, my farm is a part-time farm. You can only afford half of me. I need to go do something else as a sideline. And they did. They started building houses and changing their business model to do more custom work. These 2,000 and 4,000 acre farms, you look at this and go, well, they're not that far apart. And the reason for that is the 2,000 acre farm said, I don't want to be the 4,000 acre farm, but I need to compete with them. And so they came together and they shared equipment, they shared labor, and they created a lot of the same synergies and cost efficiencies that the large operation created. So the management accounting lesson from this discussion is there is no one silver bullet for cost competitiveness. If you don't want to be big, you still have to compete. You have to look at different strategies like joint venturing or custom sharing or sourcing part of your labor costs outside the farm to another occupation if you're going to keep these costs competitive. Number 5, what is the carrot that motivates management accounting? I get in trouble for using this term, but I don't know of very many people that enjoy doing cost and profit center reports. There may be a couple in this group, and we won't name them to embarrass them. But the real carrot is it helps identify the strategies that we can use to enhance performance in specific segments. So what management accounting does is it gives us the ability to link performance analysis and strategic management. And I think that, I can't stress this enough, we do good data management to make better decisions. We don't do data management just for the fun of creating reports. So if we can't see the paycheck of having better decisions, changes in strategies that increase ROE and ROA, then why go through all this work? And this is where the DuPont simulation model is extremely valuable. By having a model where you can put if you all took your data from last year's year end and said, that's my base case, and then simply start doing what ifs. What if we grow? What if we were able to do something, or we could maybe share with a neighbor on combines or sprayers, or share a CFO between 2 operations? How would that change operational efficiency, and see what those what ifs do in terms of bottom line ROE? That's where the paycheck comes back from good management accounting. I'd love to be in a room and have you actually show me the answer to this, and maybe Norm can come up with his fancy survey later. But how many of you would like to get a $20,000 pay raise? And if you're honest, I think everybody in the room would say, I would gladly take it. There is rarely an opportunity in a farm not to find $20,000 of waste in one or more equipment situation. And so the issue here is, how do we optimize the decision to buy, to lease, to custom hire when we're looking at capital acquisitions? The basic economics 101 principle is that we have fixed costs and variable costs in every situation, and at some point, some level of acreage or some number of hours or whatever, the fixed costs are averaged out to where fixed and variable will equal the same amount as if we custom hire. So in this simple graph, you can see that anything under 500 acres, we should probably be custom hiring it. But after we go over 500 acres, we need to be owning and insourcing that function. So this suggests that we take another dimension, another different angle look at management accounting. It's called activity-based costing. So what is activity-based costing? It's looking at process of farming in a step-by-step. So if like a crop operation, if we could come up with a total cost of pre-plant groundwork, seeding, pest control, harvest, post-land preparation, and we could get to our total cost that way, that would be an alternative to the management accounting system where we track by cost centers and we allocate. So for hogs, you could break it into stages. If you're a hay harvest operation, for example, we could break it into swathing, raking, turning, baling, hauling, and tarping. So you can take virtually any commodity production business and turn it into stages of production. So let's take a couple examples. Let's say that I'm running a large operation where I mow a lot of the residue, whether it's corn stubble or wheat stubble. We've got a 27-foot batwing motor and a 250 horsepower tractor. What would you pay me to go mow your residue? Most of the time when I pull a group, I almost always get somebody that will pay $15 an acre for me to mow their residue. This is an actual analytical tool that analyzes based on the cost of the tractor, the cost of the mower, and it looks at how many acres and hours you put on the tractor and what the annual maintenance costs are. In this particular case, the model showed that it cost $4.20 an acre to mow. $3.56 of that was the tractor and 64 cents was the mower. And this is actual data that was real data from our farm many, many years ago, where one of the most profitable things we did was custom mow for neighbors. And they were paying $7.50 to go rent a mower, $50 an hour to go rent a tractor, putting a $25 an hour employee in the tractor and putting all the fuel in. And they thought $15 was a bargain. But the moral here is it's all about throughput. We had the volume of activity and good accurate data on operating cost as well as purchase cost and depreciation to come up with this data. Let's take it a more complex issue like a self-propelled sprayer. The Kansas State Ag Manager website is my absolute favorite tool for doing this kind of optimization work. They have virtually every large combine, sprayer, self-propelled baler option that you can think of in there. So, for example, several years ago, an analysis was done on buying a used 90-foot sprayer. And that data showed $264 an acre to run that sprayer. And that was based on 16,000 acres a year. Well, just a few years back, we had to just make a decision on upgrading that same sprayer. This was our own farm data. And we're looking at now a much more expensive sprayer at $360,000 compared to $150,000. We're putting over more acres, but even at $3.89, which is a 47% increase in cost, it's less than half of the cost of a commercial sprayer in our region. So would you, if you were looking at this data, owning the sprayer, or would you custom hire? One of the interesting things that came out of this discussion was, how does operating speed impact your performance? And Brian Watkins is on the call today, and his software with CropZilla is a prime example of a tool that can really help us simulate changes in operating conditions and how they impact cost. We had an operator that was being too conservative and going way slower than he needed to. And when we showed him the net cost per acre at the speed that he wanted to go at, he realized they're not going to buy that new sprayer. It's too high. The only way they're going to buy that sprayer is if I operate it at a speed where it keeps the operating costs down competitive with the custom rate. And so good management accounting data can change behavior. He increased his speed by almost 50%, which is where he needed to be. But he also had a direct understanding of the impact of his speed and the efficiency and the cost of that operation. So Early in the session today, Norm talked about, and Randy Gangwish also talked about the fact we have lumpers and we have splitters. This chart is really how you bring those two terms together. So on the left, we have the lumpers. We have people that lump all their labor costs, repairs, maintenance, depreciation, fuel, insurance, and we could create an equipment support cost center where we take all that data and then we have to allocate it to the various production cost centers. Or we could come over to the right and we could use an activity-based cost system, or if we could come up with an accurate cost per application for land prep, spraying, fertilizing, seeding, we could get to the same cost for this equipment operations over here as we do on the left. Now, there's always the miscellaneous, which is the four-wheelers, the pickups, the weird stuff that we just never think about. But wouldn't it be nice if we could simply track everything that happened in a field and put an assigned cost to it, and when we roll all those costs up, that total on the right, is exactly the same as the total on the left. I have farm clients that can do this, and it's incredible. We have a farm manager up in Northwest Washington he's a member of our Farm Credit Board. He's a real innovator. But every year he does a complete budget cost for every piece of equipment. He rolls out the projected utilization for every one of those items for the entire year, and then he sees if that total matches what his financial budget is on the left. So that's what you call truthing activity-based costing. This would be a great topic for discussion later on in your meeting, because when we talk about how you're going to implement this, there will be some of you that want to go to the right to more activity-based costing, some of you that want to move to the left, and or combinations thereof. So kind of remember this slide as we get into our discussion later. So bottom line conclusions about activity-based costing. It's critical information for incremental decision making. It helps us decide when to insource or outsource. It helps us to set a more accurate price if we're doing custom work and trade relationships. And it can be a reasonable alternative to cost center tracking and then allocating. Number 6, it's okay to be half pregnant. There were a lot of participants in our management accounting task force that said farmers will never do this the whole way, so therefore it's worthless. And I was in strong disagreement with that comment. I said, this is kind of like climbing Mount Everest. Everybody dreams of it, but very few people will ever go all the way. But every step that we take that improves our financial management processes is better. So each step that we take, if it adds value and we know we can do that, let's do it. And when we reach the point where the last step was more painful than what the rewards were, we stop there. So if you look at this list, I think a lot of these baby steps are things that we can do and we should be doing better. We need to revisit the value of good ratio analysis and doing 5-year trend sheets and doing it consistently and having a great discussion with our team members of what those trends mean and what caused the numbers to change. We need to do, even if we just did on a backwards basis, we come to the end of the year and we develop standardized cost and profit center reports on a historical basis for the previous year. We don't even have to do WIP, but we could certainly do, for the previous 12 months, really well done cost and profit center report analysis, and then have that to compare to prior years. That would be huge in terms of its value. Differentiating between direct and indirect costs, and at least tracking our direct costs and WIP, can substantially improve accuracy of our financial statement. Most people really struggle with the indirect costs, but the direct costs are easy to track as WIP throughout the year. And at the end of the production season, we roll them out of current assets and into finished goods, and it's a simple accounting transaction. Really revisiting the importance of having a documented organization chart, well-written job descriptions, and having people connect what the management segment is that they are in charge of, and how does that relate to the cost center data that they get as feedback is a huge step in moving forward. And lastly, being more sensitive to the fact that we need to look at a lot of these unyielded transactions and make sure that they're handled correctly. Not every revenue is revenue. A lot of times revenue is cost recovery and vice versa. So rethinking at the input process level, what the nature of that transaction is and recording it correctly can give us much more accurate cost of production. Number 8, management accounting can change marketing behavior. And I could go all day on this one, but I just want to take a couple quick slides to illustrate the point here. Here's a wheat chart in 2010, and you're going, well, why is Wittman showing us a chart clear back 10 years ago? Because history repeats itself. So in 2010, if we knew our cost of production was $4.20, and we set a goal to make a 25% margin, it meant we would have to sell wheat at 5.25. How much of a window in that year did farmers have to lock in a profit of over 25%? As you can see, going into the year before we ever produced it, there was huge windows, and throughout the year, they got numerous opportunities. But how many people are sitting at crop here in January of the following year not having locked in that opportunity? So if you look at a 10-year picture of wheat prices, what has it done? $10 to $2.45 to $9 to $3. So those of us that are old enough to have experienced these cycles, I think we need to get off of this idea of maximizing price, and we need to look more and more at what is our known cost of production, what's a target margin, and then what kind of backup plan will we have to manage these aberrations where we go extremely high or we go extremely low. Corn, let's take the same concept. In 2010, those of you that are old enough to remember that year, people going into that year were expecting to lose money. It was terrible. They had to oversupply the previous year. Then they had, it priced the market. And even with that, if you said, I'm going to lower my expectations because most people are going to lose money, I'm only going to shoot for a 20% margin, there were numerous times throughout that year where they could have locked in a profit over 20%. So let's look at long-term on corn. You can see the same numbers as wheat, from 280 to 8 and back to 350, and now we're down in the 320s area. So again, same principle. I can't tell you how many times people in an audience have said, now that I've seen this, I'm going to go home, I'm going to draw a chart, I'm going to put my line on there for cost of production. When it goes over 25%, I'm going to sell. And I kind of chuckle because I know darn good and well when it gets 25% margin, they're going to go. But it might go up. Let me just see what it does. And so I'll leave that little thought with you. Conclusion number 9 is that in order for us to get where we need to be, many of us will have to develop more horsepower in our computer software to do good management accounting. When we did the task force work, we had participants from Ag Manager, FarmWorks, FBS, Red Wing, and QuickBooks deeply engaged in the discussion. FarmWorks dropped out and QuickBooks dropped out quite early in the process because they realized in order to do what we were advocating, it would require substantial rewrites of the software, and they just did not feel that investment was worth doing. Red Wing and FBS were probably the strongest leaders in the group of providing input of, okay, if you're going to do this, this is what it would take in reprogramming. And I think you're seeing today that those organizations have continued to adapt their software so that producers who want to do this have the right software to get you there. So let's take a look at a slide of what people are using. This is data from the last about 18 years of teaching at TPAP, where I poll the users coming in. And In recent years, these numbers have shifted a little bit. We're seeing more users of FBS, more users of Red Wing. So this is a 17-year average, a little bit misleading on current data, but the number that sticks out is 47% of users use QuickBooks and QuickBooks Pro. And the second most common is Red Wing, Centerpoint. FarmWorks is continuing to decline in user base, and a huge percentage of those using FarmWorks, they use it because they want it to drive equipment, and AutoSteer, that's not because they're using it for the financial accounting system. What's interesting is every year when I get this survey back, I get at least one or two new products, but it's one of these, one of those, not enough critical mass for people to share with other farmers or develop a peer group. So you have, unless you're in the 3 to 4 to 5% of this mix, in my mind, you're not at a level where there's enough users to have a critical mass to have consistency in how they do management accounting. So this is another slide that anybody that has a question later on, I'm glad to come back and talk more about it. Remember earlier we showed you the slide of the 3 columns. On the left was basic tax data, the center was additional information to do management accounting, and on the right was software that dealt more with the agronomy and ERP software. So we have quite a few players out in the industry that are dealing with the ERP side or the agronomy. FarmWorks, AgriData, John Deere, Easy Crops, Ag Leader, CropZilla deals more of the machinery, but also farm inputs. If you go down through this list, Conservice, Granular, and AgWorld are probably the strongest competitors on doing what I call ERP software. And so many of you, that whether you're using FBS or FarmWorks or you're using Centerpoint Accounting, the $24,000 question is, do I try to do this work inside my accounting system, or do I do a lot of this detailed work in my field record system and then take summary data from that system and then lump it and dump it over into my accounting system and make my accounting system be more simple? So I want to make sure everybody really pays attention to this question, because this is at the core of the debate that you're going to be having for the rest of the session today. So I'm going to restate this. What is going to be your optimal strategy? Try to do as much of the detailed tracking of management accounting information, including field data, within my accounting system, whether it's Centerpoint or FBS or FarmWorks, or do I do more and more detailed records in terms of inputs and field tracking and equipment activity in one of these ERP software packages, and then let it roll up bottom line data where I bring the totals over into my accounting system to get cost of production by enterprise? That to me is the ultimate range of strategies on how we use these different columns of software. So hopefully, I hope that makes sense, and I challenge Norm to bring that question back on the table later. A lot of people have said, why has there been so little adoption in ag? And my theory is that we've come off a set of decades where there was so much margin in the industry, we were not forced to look at this. And cash accounting was convenient. IRS allowed us to do this. And so there's been a disincentive to do good accrual performance and management performance analysis. From the lending standpoint, lenders have not cared about it because they just want to look at whole entity performance. They haven't been that concerned about why you're successful. They just want to know bottom line. Are you successful? Are you liquid? Are you solvent? Can you pay your bills? And to me, the cause-effect relationship of performance has got to be weighted much higher by lenders than they have in the past. So let's wrap this up. Finding the answer is not simple. Our daughter was a school teacher, and she had a student turn in a question to a math exam one day. When they asked, how do you find X? He simply circled X and turned the answer in. Wouldn't it be nice if this was all that simple? I think we all would agree this is a highly complex topic, and it has the potential to really take us to a new level of understanding of performance in our business, but it comes with a significant challenge of setting up the people skills and the processes to get you there. I'm going to liken implementation of management accounting a lot to those of you that have gotten into precision farming, where you didn't do it overnight. You started out with developing some guidance systems, and you started doing some yield maps. Then you added a yield monitor, and you started building some maps that made sense. And then after a while, you started doing whole farm mapping. And eventually, you were importing yields into mapping. And lastly, we finally were able to harvest that data and make variable rate application files for drills and sprayers. And we're doing a much more sophisticated form of input application. If you take that same concept and apply it to management accounting, we actually broke implementation into 15 potential steps. And again, I would liken this to Mount Everest. I won't read this today, and you can read these in the PDF that we'll send you later. But take a look at each step and say, am I doing this step? If not, should I be doing this step? And if I were to do it, how can it help me in my business? And things like doing trend sheets, taking a shot at taking the DuPont model and populating with your farm data, simulating some different strategic shifts. These are highly valuable steps. Take that next step to document your organization chart and written job descriptions and have it clearly understood in your segment managers, not only what their job is, but what information they'll get on a regular basis to help get better feedback on what they're doing. So these are all doable steps. So I'm going to wrap this up because I don't think we need to repeat the detail on these steps. I want to come back to the title, Using Management Accounting to Link Financial Analysis and Strategic Thinking. No financial analysis process is of any value unless it can be linked to what decisions you make and what the impact is of your decisions in terms of being able to measure that decision. So this focus of this whole discussion has been on what kind of decisions do we make, whether they're operational or strategic, and how do we design and put content of information in a way that we can make the optimal decision. The means needs to serve the ends. So I've summarized virtually everything we said today, that this is complex, but it's teachable. Those of you that are adopting this will have a competitive edge. It requires producers, in many cases, to brush up on things they actually knew once, but didn't see value in doing it. So they just don't do it. Now, hopefully, we're bringing this back on the table and saying, I know how to do ratio analysis. I know how to do trend sheets, but they serve a higher purpose. I should start doing them more often. It changes the focus from defining decisions needing optimization and designing systems accordingly. It isn't enough just to get by anymore. For example, we might buy a combine because we can afford it and we can make the payments, but buying that combine might not be the optimal decision. Renting it might be a higher optimization, or sharing with a neighbor. And there are tools out there that give us the ability to analyze those options and make sure that we're spending more of our energy optimizing decisions, not just doing what we can afford. Will we require professional support? Farmers are notorious for being, I can do this myself. It blows my mind how often a farmer will ask a professional advisor, well, how much will it cost me to get a trend sheet? Or if I want to do an accrual adjusted set of financials, what will it cost me? And when they get the answer, they go, just give me my tax return. We as an industry have not properly valued good information. And I would suggest maybe that this group is different, that You wouldn't be on this call if you didn't see the value of financial information, and whether or not you're going to build that support, professional team value and skill set within your team, or whether or not you outsource it. I think you're going to come away from this realizing one or another, I need to access these skill sets because this is data I cannot live without. And for those of you that are professional services providers, most of you, I will tell you this right now, you're darn poor salesmen. You know that your customers need it. We need to do a better job of helping customers realize that this is not only doable, but it's affordable. And the payback in terms of better decisions will come back to them many, many fold. So it's going to take work on the part of professionals to develop better examples of success stories and what the real benefits are of the things we're doing today. Because most people just see a lot of work and they see a lot of cost. So Norm, that wraps up my formal comments here. I wanted to leave a few minutes if there was any burning questions, and I will still stay on here for your discussion later.
Well, thank you, Dick, and the mic is, we'll unmute you, and if you want to ask a question or send a chat here, and I can repeat it. So, big opportunity. Go ahead, and anybody wants to unmute themselves and ask Dick a question.
Hey Dick, this is Bob Krugmeyer. How you doing?
Good, Bob.
I had a question for you related to the growth and the cost efficiency kind of analysis that you did. From your experience, what are you kind of seeing for like kind of the life cycle for that? I know kind of the way that I'm seeing that in my mind is when operations would first start out, that's when the cost efficiency would be very important. And then as they start to grow more, as they have more of those kind of fixed costs, that's when kind of that that's when that growth model would that's when that would kick in. I guess what's kind of, after you guys kind of came up with that analysis, what's been kind of like your practical application of kind of seeing that life cycle, and what does that look like to you guys?
Well, Bob, I think you look at a typical entry-level person, typically when they come into a business, they got to have some basic equipment and they got to have their own labor that's got to be paid for. And so there tends to be a higher proportion of fixed costs in relation to variable costs. And so some of their early career strategies are they've got to grow to get that fixed cost down to a competitive level. And they also need to look at more outsourcing strategies, maybe doing some custom work, or maybe to be sharing some equipment, because without doing that, their cost structure is completely uncompetitive. Once they're in the mid-career where they've actually grown to what I would call that sweet spot of economic scale, this is where I think the fixed costs are now kind of under control, and this is where cost efficiency can really come into play. So looking at the impact of precision farming, looking at the impact of changing your cropping systems approach and redesigning the integration of cover crops, or could be making the transition from intensive to strip tillage or no-till. These are really big transitional things that involve changes in systems, in processes, and equipment. But what I see in terms of the long-term really successful producers are people that are continually looking at both what is the optimal growth strategy and what is the optimal cost efficiency strategies I need to pursue. I don't think it's one or the other. I think it's a blend of both. And where you place that emphasis is going to be higher probably early in your career than what you do later in your career.
Thank you. I appreciate that.
More questions?
So, Dick, this is Randy Gangwish. I'm wondering what you see as far as the value of, many of us have some multiple entities involved in the business, you know, whether it's a little side trucking business or farming versus seed dealership or something else. So where is the value that you see as far as consolidated review?
Well, I think you have
And,
almost.
and let me back you up a little second here. The ownership probably is not the same in all those entities.
Okay, great. Well, if the ownership is identical, then the consolidation of those entities does give you a big picture look. But if you're doing a good job of transfer pricing and there's real clear accuracy on reasonable costs that are shared between entities, I think you can have real meaningful analysis from a management accounting standpoint, entity by entity. And if you have different ownership mixes, it's all the more reason why each of those entities need to be analyzed on their own. A banker may want to take a look at a consolidation just because maybe there's commonality in guarantors and so forth, but they're looking at risk of getting a loan paid back where they're just looking at backup systems. They're not looking at performance entity by entity. So I think it's a great question, and it does have a lot to do with whether or not the ownership mixes are the same and whether or not you're following a consistent approach to transfer pricing.
Thank you.